One of the biggest downside of subject to investing, seller financing, creative financing in the today's market is, drumroll, this is something that no one is talking about. Personally, I love subject to and seller financing, creative financing is the only way I would buy real estate. That said, there is a massive risk versus today versus when I got into the game in the last crash, 2006, fourth quarter, 2007, 2008, 2009. Okay, what is the major difference? Leave a comment below. Think about it for a second. What is one of the primary difference? I'll tell you. Okay, this is what makes subject to seller financing so dangerous in this market. More than likely, you're going to have an ultra low interest rate. Okay, but today's interest rates are higher than before. This was the total opposite back in 2006 fourth quarter. 2006 fourth quarter, interest rates were at all-time high, and then the market crashed and interest rates became all-time low. So why does that matter? Well, as a lender, if the bank owns the note and they see that there's a transfer happening, in my opinion, there's going to be less likely to call up the note on a loan that, today's, let's say, interest rate that the bank was getting back in 2006 will be, let's say, 4%, but the loan that I took over had an 8%, 9% interest rate. So it doesn't make sense for the bank to pay all that foreclosure cost, pay the trustee, pay the holding fee, pay the realtor, pay the insurance, and then come and lend the money out at a lower interest rate. Versus today, it's the opposite. Today, if I take over someone's mortgage, they're probably going to have ultra low interest rate, almost 0%, and then today's interest rate on the mortgage is 5%. So it makes it more favorable for a bank to say, look, I'm going to call up this note because I can lend out the same exact property, the same exact money, with a higher interest rate and make more of a spread. Okay. Now the only caveat is going to be when the prices start shifting because of the economic crash. But the only downside that I see in seller financing, besides the due on sell clause, which is basically what we're talking about, and why in today's market it makes it more attractive for lenders to call the note in, basically to exercise that due on sell clause, because of interest rates today are higher than the mortgages that I'm willing to buy from a seller with seller financing. Okay, because more than likely, if they got a loan in the last 5-6 years, their interest rates are going to be ultra low. Okay, that is one of the primary factors that no one's really talking about. But all the other stuff is the same. The positives and negatives is exactly the same as I've explained it before, in my opinion. But I'm not a financial advisor, not an attorney, not a CPA. I'm just a refugee to America. However, the only token is that interest rates are today higher than the underlying notes on homes that I'm talking to. Okay, which creates a flag for me, and the flag is, how much money am I going to put down? Because on a seller financing, I don't want to put a whole lot of money down because there's a due on sell clause that increases the risk for the seller and for me as the investor buyer. So I want to make sure that in today's market I put the least amount of money down, because that increases the chance of that foreclosure because of the due on sell clause, because of the interest rates being what it is, from the underlying mortgage being ultra low versus today's markets being a lot higher than before. So banks are more likely to say, look, let me just call this note and foreclose on it. Okay, so the caveat for me is to make sure that if I'm looking at the property, I want to make sure I get a property where I put the least amount of money into the property. Okay, 0, or hopefully you have the seller pay me some money to take to buy their home, or aka take over their payments in a sense. That's my best option. My second best option is where I don't have to bring anything to the table, very little, as little as possible, because the more I put down, and if the bank calls the note in, not only does the seller get hurt, but I also get hurt because of the money that I put down. So that is something that I'm going to be thinking about, because in the last 2006 fourth quarter, 2007, 2008, I could sink 10 grand in each property and I'll be okay with it, because I knew that the probability of the bank calling the note is very, very low. because the note was performing. I was making payments. At the same time, if the bank called the note in, they had to pay all that foreclosure costs, pay the trustee, pay the insurance, pay all that stuff, title, all this stuff, right? And then go and lend the money out at a lower rate, because that's what happened in 2006, 2007, 2008 crash, when mortgage rates started coming back down from subprime being like 9, 10. I bought properties that had 9% interest rate. Okay, where today, before what's happening today, you could have found mortgage rates is almost 0%. So if you like this video, guys, thank you so much for clicking the like button, clicking the subscription button, and at the same time, I really appreciate if you go out and check out some of my courses and some of my books at myrealestatedojo.com. Always remember, you're braver than you believe, stronger than you seem, smarter than you think, and twice as beautiful as you ever imagined. Thank you so much for your support. Peace.